Oh, ladies and gentlemen, Ari Wald, Chief Market Technician at Oppenheimer. This is a pleasure, Ari. Thank you for being here.
This is great to be on. Hey, JC, have you ever seen the video where the dad yells out to the kid, like, give him the stuff?
Yeah.
And the kid throws it and he gets launched. He's like, no, don't give him that anymore.
How much time are you spending on at baseball fields these days?
Pretty much every day.
Wow.
Though it's a lot of fun. My oldest plays 10U. My middle's 8U, though he fractured his elbow right before the start of the season there.
It's not good for baseball players to have a fractured elbow.
No, it's so much fun. I told my kid that you'd give him some pointers, and then we realized you're an hour and a half away, but we'll have to figure something out.
Yeah, listen, we can work on his balance a little. I could give him some tips. I mean, I'm no Hall of Famer over here, furthest thing from it, but I pitched a few innings in my day.
I love it. And you want me to talk about credit spreads today?
How can we not, Ari?
That's like my entire presentation. Good thing.
Can you just give me a little before me and Straz are going to bounce out of here in a second? But can you give me a little tidbit? If it's 1987 all over again and the market's going to crash, why aren't credit spreads blowing out?
No, it's after last year was 87. That was the non-recessionary reset. We're in the late economic bull cycle that's still intact. And credit spreads are why you want to buy this volatility. They're absolutely unfazed through this pullback, JC.
Are we buying stocks here? Is this just a normal seasonal correction? Is that all this is?
It's just been too textbook, right? This seasonal setback.
It is a little. It has been a little too textbook for my taste.
Too textbook, right? Yeah. When are we going to go off course? But as it stands, listen. Opportunity for long-term investors. I'm not one to ring a bell. I don't know if today might not be the low. Probably go down and test that 200-day average. But no, this is kind of very textbook, orderly, no signs of stress, correction. Just enough of a shakeout there. Get some of these non-committal bulls kind of out the door. I think it resets everything, and we're set up for that Q4 rally.
Is that why we haven't gotten a relative bid out of staples and low volatility stocks? Or I mean, I'm hearing it's because bills are paying so much.
That's part of it. But if it was anything worse, you would expect rates to be going down, not up, and you would expect a lot of these safe haven sectors to be catching a relative bid as well, which they're not. So for all those reasons. No reasons to stray from the seasonal correction roadmap, how we see it.
But Ari, if you're an index investor, you're not going to make any money until tech breaks out. Am I wrong?
Yeah, that it led us up. It's weighing us down more recently. But that's the sector where we see the opportunity, where the support levels are intact. And you got to get that sector going, which is consistent. That is the most offensive sector of all of them.
Tech, more so than industrials.
More so.
Ari,
in a bull market, you'd expect tech to outperform more than any other.
Does that thesis need interest rates to roll over for tech stocks to keep working higher?
Great question.
The sector gets discussed with interest rates as if there was a 1-to-1 correlation, and there isn't. A moderation, I think it would be what you'd like to see for market as a whole, which pretty much is technology at this point, is for rates to at least start to moderate. I don't think they have to go down. They have to moderate. Right. But Straza, 60s, 50s, 60s, interest rate rise, secular bull market. Guess what a sector was a leader through that market as well through the 50s and 60s? Technology.
RCA, baby. RCA, right?
Wow.
Technology.
Okay. Good. And all these tech stocks are different, right? Like the speculative tech stocks might be hurt more by rising rates, while these big boys might be just fine with it.
Yeah, you've really gotten the rotation within the sector. That's what's so telling. It's one of the big client inquiries we got. We've gone through all of 2022 just to see technology reclaim its leadership, but you've really seen the rotation within the sector. What was software as a service or innovation and internet has been very AI driven. And so you're seeing the more speculative parts, I think, are going to be more of a beta trade, small cap tech in particular. They could work for short bouts at a time. But the big names, the large cap tech names, I think are still structurally intact and set up to continue to lead the way higher over the long term.
Straza, we're going to let Ari run here, but can you ask him that question that you said about software?
One more for you. I think you'll be a good judge of this. JC's giving me a hard time. I told him software stocks are the best stocks. period. They've been the best stocks.
Tell them what else you said, that it's one of the most important indexes in the world.
Yeah, everybody owns them. They're huge. They're the best companies. They can scale unlike anybody else. They rewrote the rules of
You can't
fundamentals.
put them in the same category as semis or homies or
Better
industrials.
than semis because they don't have that. Let's hear what Ari says.
Well, I'll tell you this, through the initial parts of the August correction, they were showing some very notable relative strength. They were kind of the area of technology that were last to get going.
Yeah.
They finally got going in that summer. And I think they are set up to participate with the sector going forward. I think it's not going to be the same software trade it was a couple of years ago. I think some of the smaller are more speculative, and the ARC type, anything, I kind of look at it, I think in terms of the chart. I think of the software stuff, if you retrace back to the 2020 lows, beta trade.
It looks like ARC.
Buy and sell it. If you held the breakouts from the fourth quarter of 2020, secular uptrend intact, those software names still set up for the long term.
But Ari,
I like that.
Regardless of that,
look at this.
would you put software in the same category as the most important indexes in the world with semis? No, right?
As far as strength is concerned,
just importance to the market, importance to you, right? I would put it as a subcategory, not in the elite most important areas.
I think it's because they're some of the most owned stocks.
Yeah, software is a bigger area. I probably just is given its scale, probably some greater importance there. But I think really at the end of the day, large caps, small caps, that's the key relationship. All these industries, they kind of ebb and flow as far as what's the most important one right here, right now. Industrials, financials, semiconductors. End of the day, I'm looking at large caps and I'm looking at small caps. I think small caps are the most important gauge right here. They need to hold. If I'm wrong on any of this, it's that small caps are going to break lower. They haven't yet.
If small caps break, financials break too. They look the same.
Oh yeah, I mean, just given the weighting and a lot of small regional banks within there.
I think there'll be an early tell from the microcap index. IWC is right there. It closed at a new low yesterday. It's getting dicey.
All right,
getting close. We got close in the second quarter too.
Listen, we're taking away Ari's time. Let's let him go. Ari, I love you, brother. Listen, do your thing. We had to ask you a few questions. We can't help ourselves. Go do your thing, my man.
You'll pull me off if I need to. I'll try to go 10:30. Are we going to do Q&A at the end?
Yeah, try to go to 10:35 or so.
Perfect.
And then Ari, do you want to share your slides, or do you want me to run them?
I would love to share my slides. Let me see if I can figure out how to do this.
Just do that plus sign in the middle.
Guys, this is where you grab your pen and pad, get ready to take some notes. Ari Wald, one of the best in the business, one of my personal favorites.
All right. The floor is yours.
Here we go. Okay. Just last night, knowing I was going to be on Chart Summit 2023, I published my charts of the month, and I wanted to share these slides with everyone today. They're actually a summary of a lot of the commentary we've been publishing in recent weeks, but we updated all the slides, put in some fresh commentary to keep it fresh. And I want to start with the key takeaway, and I'm going to read it right from slide 2 here. And it is this: the global equity market appears to have entered the capitulation phase of the correction when selling temporarily becomes indiscriminate. We see this as a buying opportunity for long-term investors. Near-term traders should monitor for a key reversal day around the index's 200-day average, marking support at 41.95. A failure for the Russell 2000 to maintain its year-long base would pressure our longer-term outlook. This is where we see relative risk. So those are the points I want to discuss. I also just want to call out, I am very active in the CMT Association, as JC is, as Straza is, and I just want to flag that I was featured on the latest Fill the Gap podcast hosted by Tyler Wood, one of the presenters on today's summit, David Lundgren as well. So for those that haven't checked it out yet, if there's an interest in technical analysis, please give it a listen, and I hope you enjoy. Going to start first with seasonals. That was the question I got that JC led with, just because it's been so textbook. And this chart in particular has been my most requested chart. We posted it. We've been following it all year. I mean, again, for us, seasonals are secondary confirmation. I will never tell anyone to buy or sell the market based on just typical seasonal tendencies alone. But when our indicators and what we're seeing in the charts align with those seasonal tendencies, it does add to our conviction. It was a reason that we were positive coming into the year, making the case that the S&P 500 would climb the wall of worry to 4,600. Late July, when we got to 4,600 and put in that bearish reversal day right at that level, a day where we gapped above 4,600, couldn't uphold that strength and closed lower, typically an indication of upside fatigue, we showed, well, not only are we seeing signs of fatigue, but it is occurring at a time in the calendar year where the market has typically seen weakness. And here in particular, the gray line looks at the average composite of the S&P, looking at the last 10 pre-election years dating back to 1983. And what we're showing here is typically after a very strong run in the first half, best part of the typical 4-year presidential cycle, excesses in the second quarter typically recede in the third quarter, and then you'll see strength return in the fourth quarter. We've followed it this far. No reason to stray from it as it stands. That this was the roadmap that we've been discussing, and until shown otherwise, and we'll go through some of those indicators, and nothing to suggest that we should stray from it as it stands. And so for these reasons, we are looking for an opportunity to buy stocks. And we're thinking in terms of bull market oversold conditions. First, S&P 500 with a 200-day average, you see the rising slope of the 200-day average. That's just a very simplistic view of the proxy for what the trend is. We typically say corrections into a rising 200-day average are near-term opportunities to buy long-term strength. First, for the daily RSI, we kind of discussed a reading below 40. That in a bull market condition, we don't think this indicator has to get below 30. That in a bull market, you might only see a reading that gets into the 30s, and looking for a below 40 print to mark oversold. We got that. What we didn't get on the first leg lower in August was a spike in volatility. We've gotten that more recently. Now, thinking in terms of the VIX, the very low readings that we've seen with the VIX coming off a print, I think, of around 13, its lowest in a number of years, that's a good thing. That's an indication of a bull market. The VIX typically only gets that low in a bull market. What we'd like to do is then normalize the VIX against that environment. And this middle panel specifically is looking at the deviation in the VIX from its 3-month low. And that, again, helps normalize for different environments. And what we found is that typically a 50% spike from its 3-month low when the S&P is in an uptrend above the 200-day average, typically good buying opportunities. That was triggered yesterday. We got to 50% on the mark. Now, listen, that doesn't mean that's not eventually going to peak at 55% or 60%. Not making the case yesterday was the low, but at the least, it is an opportunity for long-term investors to start to purchase their top positions, that the conditions are coming into place for this market bottom. Typically, you'll look for some sort of reversal day. And again, that 200-day average converging with the breakout above the February peak, right around 4,200, 4,195. Let's see if we get a day where we move below it and then swiftly reverse higher into the close. A bullish reversal day indicating downside fatigue potentially would set up that Q4 opportunity. Not only I want to talk about credit spreads. Another concern that we've been getting inbounds on from our clients is regards to rates. Straz asked me about rates and whether the technology can continue to work in that environment. For us, rates are not a significant concern. And even the yield curve in that regard as well, the inversion in the curve, it's been inverted. We're making the case for the right reasons. That to us, looking back at last year, the worry wasn't the inversion. It was the risk of runaway inflation. That the market topped when the curve was still in positive territory, when long rates started to shoot higher, when you had a near doubling in the 10-year from 1.5% to 3% in a nearly 4 months time frame to start 2022. That's when you saw credit spreads balloon wider. You had a very risk-off move in the market towards those defensive sectors. That was what the key worry facing the market. Summertime, even starting in the second quarter, Fed came in. They wanted to squash that. They started to hike interest rates, which was a reason for investor worry in itself, higher interest rates, to which we said, no, no, no. If the alternative is runaway inflation, we welcome higher interest rates. The curve was inverted purposely for that reason, to limit runaway inflation. The Fed wanted to avoid their mistakes of the 1970s when they arguably cut rates too quickly and inflation came resurging back. And it led to bigger downside drops in the subsequent years. In the late 70s, Paul Volcker came in and said, no, 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 we're going to keep the Fed funds rate well above the level of CPI. We welcome for the Fed to do that once again. I think that is going to allow this equity bull cycle to continue. This is the key positive for us. That while tighter policy, and don't get me wrong, we ran the numbers. When the last policy change has been a hike versus a cut, the returns aren't as strong. But what we found is that difference is actually only marginal. It's only a very small difference. That tighter monetary policy marks more late stage economy, not end of stage. That the time to get worried is actually when short rates fall faster than long rates, as the Fed actually cuts policy to combat an obvious deterioration in economic activity. We're not seeing that. What we see is the recent rise in the 10-year is an economic repricing from low growth, from no growth, and the higher for longer monetary policy, and volatility that is triggered due to those reasons is volatility that should be bought. Now, listen, I would argue that we want the pace of this rise to be gradual. I would argue it's not high rates or low rates, but stable rates. And to this point I was making to Straza, perhaps we need some stability in the 10-year to allow technology to find its footing and for the market to start moving higher again. But the risk here is directionally, I would still welcome, a gradual rise rather than a significant deterioration, which in our view would indicate that imminent recession risk has come back to the table. And that gets us to the point about credit spreads. Our intermarket checks remain bullish. We are not seeing the same type of reaction we've seen on this pullback as we saw the start of 2022. Here's the equal weighted S&P, and it kind of fits into the discussion I'm about to make for the Russell 2000. Bent but not broken, oscillating around the 200-day average. We haven't seen the broad-based breakaway just yet. Going to be important for it to hold support. Could this just be another Q2 reset where it got ugly? It got very close to breaking, but it did not, and then it set up an inflection to the upside. Why we think that is likely? Because if you look at high yield credit spreads, they've actually narrowed while equities have moved lower. No major signs of stress underneath the surface through the setback. Typically, you'll see a deterioration, a widening in this credit spread as you did going into 2022. Not seeing that again. Why we think this pullback has been orderly, more of a shakeout, and resetting some of those excesses that got worked up into the second quarter. The key for us is going to be small caps. We've made the case and continue to make the case that the market is narrow, but not narrowing. That it's actually from broad-based selling last year when nothing was working, it's selling that's gotten more concentrated. And there's pockets of the market that have started to work, most notably on the large cap side. So for that to hold true, it's going to be important for the Russell 2000 to hold the base that's been in place since last year. Going to be to hold the trend of higher lows. Conversely, if we get a break of that base, then we're at the risk for market breadth to expand to the downside and for the laggards to drag the leaders lower with it. That it would derail our breadth is showing directional improvement argument. Now, I also want to kind of key on that there is a difference between narrow leadership and narrow participation. Don't confuse the two, because a lot of pundits go on CNBC and they talk about the leadership of the S&P 500 and large caps as if that's a bad thing. It isn't. Again, we want small caps to participate, but they don't necessarily have to lead. That relative performance is a zero-sum game. For every market cap of outperformance, there has to be market cap of underperformance. So if those very big stocks are going to do well, by simple mathematics, fewer stocks are going to outperform against that backdrop. But that doesn't mean that fewer stocks are necessarily outperforming. So as we think about this new relative high for the S&P 500 versus Russell 2000 ratio, the highest print with the S&P in the numerator since 2001, if you were to look back, we would show that this is actually historically consistent in a secular bull market. Here we're looking at the Russell 2000 and the relative ratio versus the S&P 500 in the bottom panel. And what we're showing here is that through multi-year bull cycles, through the 1980s from 83 to 1990, then again from 94 to 95, we had large caps lead on the upside, small caps still participated. Again, the difference between narrow leadership and narrow participation. Those weren't narrowly participated rallies. It was narrow leadership, but not narrow participation. We want to see that once again. I think what's notable is that the more recent shift towards large caps, from our vantage point, occurred in 2013, the multi-year turn. And that was when both small caps and large caps were breaking above big long-term resistance levels. So again, consistent with the secular bull market that we believe we're in. Still, want small caps to hold the base. Okay with large caps outperforming though. This becomes less surprising when we consider technology's weighting in the S&P 500. 27% weighting in the S&P, only 13% for the Russell 2000. This combined with the fact that the technology sector has outperformed during 20 out of 23 bull cycles since 1932. This is the top hit rate for all sectors. If we're of the view that the bull cycle is intact, more often than any other sector, technology typically outperforms, and due to the weighting in the S&P 500, it shouldn't be surprising that large caps are outperforming small caps. They have been a drag of late, but what I'll show you in a moment is that the support levels are still intact. So as we think about opportunity on this pullback, if the bull cycle is intact, as we believe it is, we think the opportunity is in technology, which again typically leads in a bull market environment. Here are the pieces to the growth and value ratio, the absolute charts in the top, the relative ratio in the bottom. What's notable for us is you had a laggard last year growth, reversed higher in March, first moved above its 200-day average, confirmed the reversal in May. And as we talk about excesses receding, that's exactly what has happened. That ratio has moved sideways while the moving averages are catching up the price. The breakout is intact, and the conditions are in place for growth to reclaim that leadership. And at the same time, the growth benchmark was the one that broke above its August 2022 peak, coming back in, testing the breakout. Very often, former resistance becomes support. The issues on the value side, and this is not surprising, as we think about the long-term relationship between growth and value and the divide that's developed between those two factors. We've agreed. Everyone quotes, growth hasn't outperformed value by this extreme of a degree since the late 1990s. That's true. In the 5 years going into the year 2000 peak, the NASDAQ 100 was up over 1,000%. We haven't seen returns anywhere close to that in the current cycle. The rate of change has had a much more of a sideways look to it. There's been small minor run-ups along the way, but there's been checkbacks as well. And the most recent checkback just occurred last year, where now if you look at this rate of change and you look at a 2-year rate of change, any sort of long-term time horizon, you'll see that the NASDAQ 100 coming off some of its lowest levels in over a decade. since 2010. This is why we've argued that the steadiness of growth is underappreciated, and why we think this steadily paced secular ascent is positioned to resume higher, both over the near term and potentially long term as well, as we think about the coming quarters. That instead, the outlier has been what has happened on the other side of the equation. It's been how poorly the rest of the market has performed. Here's a look at the value factors 5-year rate of change. And we first highlighted this chart in 2020 to show that it was actually value coming off long-term rate of change levels that comp to 1940, 1974, 2002, and 2008. Just 3 years ago, value had put up no performance over a 5-year period, that which was similar to these major market low points. And that our thesis was that if the divide was just as extreme, if in the late 90s it was corrected by growth catching down, this time around it'll likely be driven by value catching up. Can Europe finally extend its gains out of peak levels from the year 2000? Can energy become an investable sector again? All trends that we're rooting for, we're seeing some selective strength, but just in terms of broadness and where we have the most conviction, we still believe that the long-term risk reward is still more favorable for growth, and that's steady trend. So, and of course, the answer is going to be somewhere in the middle. That it's not going to be as strong as the late 90s. It's not going to be as weak as it was at these prior low points. But again, the answer is somewhere in the middle, and at the very least, makes the apples and oranges comparison to the late 1990s. What's interesting is if you were to strip out growth, what you'll find is that cyclical value is still outperforming versus defensive value. And this is what we did on this slide, looking specifically at the ratio of Russell value versus S&P low volatility. Because Russell value is you get a mix of both cyclical and defensive value. So if you were to divide it by a more defensive benchmark, you get a better picture of the cyclical value versus defensive value side, specifically energy and financials divided by utilities and staples. And we broke down the two benchmarks, and that's pretty much what we're looking for. So energy has been a big driver of this strength. But again, the point is that we haven't seen that move to those safe haven sectors like staples and utilities that would give us concern. Again, the differences between the pullback now and the weakness going into 2022. So we like energy selectively. So kind of, again, growth is kind of where we're seeing the broadest strength. There's selective strength in cyclical value, energy being the notable standout there. I'm unsure if this is a super cycle in energy and oil prices. The reason being that I just don't think the dollar is weak enough to support that. Here we're looking at the long-term look of West Texas crude and the US dollar, inverse relationship between the two. The last big multi-year super cycle for oil was accompanied by a 40% drop in the DXY. This time around, dollar finding its own support level, finding some stability there. I think oil is also has a very similar look. Got to respect both trends. Looks like strong dollar and strong oil, but taken together, what we see is perhaps more of a range-bound oil market. Price of West Texas generally back in its 2010, 2014 range. Probably a ceiling out there, and at least selectively looking at the components of the energy sector, we would side with some of the E&P names, the names that have already broken big long-term levels above their peaks from 2014 and 2018. Less sure about the service names, which have surely been relatively strong from a trading basis, but still sport a long-term look of lower highs, where we just say this. We always think, what's that going to look like if it starts going against me, if it starts pointing south? And I would not be able to defend the service names in the same way I would be able to defend the E&P names. And for that reason, why we would stick with the E&P names that through some combination of holding up better on the downside or acting stronger on the way back up, they've been able to clear those big long-term levels. But the final piece here, again, we are momentum investors. We say we are momentum investors that overlay technical analysis on top of our process. We think we are at a point in the cycle where momentum investing comes back into style. It was a tough first half of the year for the factor. It's actually outperformed more recently through this setback. Typically what we found is that both during the equity cycle and economic cycle would favor momentum. That typically about 9 to 12 months after an equity cycle low, you'll typically see the momentum factor outperform. And what we also found is that when the yield curve is inverted in a late economic cycle, you'll also typically see high momentum outperform low momentum as well. That typically the divide widens at this point of the economic cycle. The leaders have already been established. So in terms of leadership, here's the technology spider. Big breakout through its August peak, setback into the breakout point, into the 200-day average. That's where we see opportunity. Listen, during this indiscriminate selling phase, the market's going to go for the leaders as well. Is today the low? Could it get pretty ugly there on a very near-term basis for some of those names? Yes. But we've also have found that typically those are the names that are bought most aggressively on the subsequent turn. Conversely, why cyclical value hasn't been more broadly strong is the banks are holding it back. Banks are holding the Russell 2000 back. And so why going into late July, into that seasonal setback, we had suggested selling banks as a seasonal hedge. They had rallied into their bearish 200-day average. We moved them to underweight. Now we're at the point where this could be part of a base building. It actually there's a lot of similarities to the action in banks in 2020, where they had rallied up to the 200-day. There was one final setback, a higher low, and then they sprung higher. Something we're rooting for, but this is, again, the weak get weaker. What we found is that when the market tide recedes, very often it's a lot of those weak areas that continue to drag the markets lower. And so for those reasons, we want to see that in banks. I'm open buying tech on the earlier side. I'd rather be a little late with banks. They're low momentum for us. We want to stay by our discipline. And for that reason, that's going to be the key area to turn. That's what's holding the Russell 2000 back. We're going to need banks to ultimately get going if we're going to see this broad-based breakout, which we haven't seen yet. Again, it's kind of this breadth is stuck between a bull and a bear. This has been stronger than a bear market rally, but we haven't had confirmation of this new bull market either. And to get that confirmation, this needs to turn into a base. And so why we're watching banks closely, why we're watching the Russell 2000 closely. And it's generally, and I'll kind of finish with the final takeaways being just that. It's a recommendation for offense over defense. The sectors that rank highest in our momentum scores would be technology, industrials, even actually energy on the most recent update is right up in there in the top 4 as well, with discretionary. For us, I think it could be selective at the industry level buying E&P. And underweight for us, aside from banks, just as a beta hedge there, the poorest relative trends in our work are going to be consumer staples, REITs, utilities, pockets of healthcare as well. And I think that's telling in itself. And again, for all those reasons why we believe that the longer term positives indicate near term weakness should prove an opportunity to buy into an ongoing market advance. And that is my presentation.